Bitcoin has just ripped to almost $119,000, and if you've been following my channel recently, you knew a volatility spike like this was right around the corner. But the big question now is, how long can this rally last? And more importantly, what signals should we be watching as we push deeper into price discovery? Well, in this video, I'll walk you through the key metrics and critical levels I'm tracking right now, so you can stay one step ahead as the next phase of this cycle begins to unfold. Bitcoin's volatility lately has been coiling up like a spring, tightening more and more, waiting to snap. And if you've been watching my recent videos, you'll know I've been banging the drum over the past few weeks, saying a big move is on the horizon, either to the upside or the downside. Based on the data I've been tracking, I was leaning towards the bullish side. And one of the most compelling metrics that's really grabbed my attention over the past month is the long-term holder 30-day net position change. This is one of my go-to indicators for building a macro view of what Bitcoin's most resilient participants, often referred to as the smart money, are doing behind the scenes. Now, the big takeaway here is that the number of long-term holders has been surging recently, and not by a small amount. We're currently looking at over 15 million Bitcoin now held by wallets classed as long-term holders. That's about as high as it's ever been in Bitcoin's history, and it really reinforces the idea that conviction is building across the board. It's no exaggeration to say that this is one of the most bullish signals the market can offer, because it tells us that supply is tightening, and the people holding aren't in a rush to sell. When this metric flashes green, it's showing that more participants are shifting into long-term conviction. They're accumulating with the intent to hold. And crucially, they're not selling into strength. That kind of behavior is powerful in a bull market because it reflects confidence and reduces available supply. Historically, these green spikes have aligned with some of the best dip buying opportunities we've seen, as they tend to mark accumulation during moments of temporary weakness. Long-term holders are generally the most rational investor cohort in the market. They're less prone to emotional decisions, less likely to chase pumps or panic on dips, and far more likely to act based on data and long-term fundamentals. On the flip side, when this chart lights up red, it means these same holders are choosing to sell, usually into strength, at or near local tops. They're taking profits strategically, and that often aligns with overheated conditions in the market. So, if you're serious about timing the market with any kind of edge, this is one of those charts you really want to keep an eye on. It gives you a clear signal of what the smart money is doing, and that alone makes it incredibly valuable. Recently, even as Bitcoin was hovering around its all-time highs, we saw this net position change metric turning sharply green, and that caught my attention. Despite the elevated price levels, long-term holders weren't offloading, they were accumulating. That signaled to me that the rally wasn't finished. Pair that with compressed volatility, and I had a strong reason to lean bullish. But here's the thing. Even when the signals look strong, it's critical to stay grounded in probabilities, not emotions. So let's shift gears and let me walk you through three of my favorite metrics for short-term Bitcoin trading. The first is my short-term risk score. I've broken this down in detail in a recent video, but put simply, it's a custom indicator that blends 8 of my top on-chain and structural metrics into one clean, normalized score. It's designed specifically to assess short-term market risk, particularly useful when the market starts to overheat. And right now, we've just flipped above the midpoint line. For me, this midpoint acts as a personal dollar-cost averaging signal. It tells me to start easing back, to scale in with more caution and avoid aggressive entries. But I'm not looking to trim my position yet. That only happens if we push into overheated territory again, similar to what we saw in March and November of 2024, when the risk score spiked above 70. Until then, I'm content to let the trend play out, or wait for it to dip back into my lower accumulation range again. Next up is the Z-score probability waves, which is one of my favorite metrics. The most recent rally, especially in the last 24 hours, has been statistically significant. We've pretty much touched the +2 standard deviation band, which is the orange zone on the indicator, and this currently sits around $118,000. Historically, every time Bitcoin enters this zone, the odds of a short-term pullback increase substantially. And when we move into the red zone at +3 standard deviation level, now around 123,000, the market almost always reacts with a pullback or consolidation. That said, hitting these levels doesn't automatically mean the rally is over. It just means that if you're short-term trading or looking for high probability entry and exit points, the odds start to favor some kind of correction or pause in trend. My base case right now is that we either see a mean reversion to the $110,000 to $114,000 range, or make a final push into the low 120s before retesting that previous all-time high as support. If we hold that level convincingly, it could act as a new launchpad for much higher prices. So, let's say Bitcoin does break out from here. What's the next realistic target? One of the best tools for answering that is the classic MVRV ratio, especially when you enhance it by overlaying sigma bands. This gives us a cleaner, more statistical view of where the market might start to overheat. What we're seeing right now is that the $140,000 region is where the average investor's unrealized profits start to look a little overstretched. Historically, that's the kind of level where the market tends to begin a cool-off period, either through sideways consolidation or a short-term pullback. Now, that doesn't necessarily mean we have to stop there. Markets can always overshoot, especially in euphoric environments. But it is the zone where caution starts to creep in, and where probabilities start shifting towards mean reversion. It's a spot where, if you're a short-term trader or managing risk, you want to be extra aware of positioning and sentiment. This bull market so far has followed a textbook step-ladder structure. Sharp, powerful moves to the upside, followed by long, grinding, choppy consolidation phases. That kind of market structure is healthy. It allows momentum to reset, over-leveraged positions to flush out, and for price to build solid support levels that act as launch pads for the next leg up. For now, we're still waiting for the parabolic phase of the cycle, that moment when the step-ladder framework gets thrown out the window. If that phase doesn't materialize just yet, then I'll continue to approach the market step by step, looking for the next leg higher within the same structured, measured rhythm we've seen so far. But if we do enter that parabolic phase where we start to experience face-melting vertical price acceleration, then it's time to ditch the step-ladder model entirely and start thinking in terms of macro cycle tops. At that point, my focus will shift to a completely different set of metrics, like my omega score and cycle top lines, that tend to signal cycle exhaustion. But we're not there yet. For that phase to kick in, we need retail euphoria to return in full force. And right now, we're simply not seeing that. The foundation is building slowly but surely, but the spark that lights the final euphoric fire hasn't arrived yet. That tells me we're in a transitional phase, caught between late-stage accumulation and the explosive phase that defines every cycle top. Whether we continue the step-ladder climb or shift into a full-blown parabola will depend on what comes next. Until then, I'll keep tracking these signals closely and try to keep us all one step ahead of the herd. So, to wrap things up, what we're seeing right now is a market showing clear signs of strength beneath the surface. Long-term holders have continued accumulating, even at these elevated levels. That kind of behavior sends a strong message. Conviction is high, supply is tightening, and there's very little appetite to sell into strength right now. It's one of the most structurally bullish signals you can get at this stage in the cycle. At the same time, indicators like the probability waves are beginning to flash signs of potential short-term mean reversion. Nothing dramatic just yet, but enough to suggest that a pullback or a period of consolidation wouldn't be out of the question. That doesn't mean the rally is over. It just means this isn't the moment to FOMO in. This is where staying calculated matters most, especially if you're operating on shorter time frames. And finally, we still haven't entered the parabolic phase of the cycle. That final leg higher, the one driven by widespread retail euphoria, is still absent, which tells me we're likely not near the macro top yet, but also not quite in full breakout mode either. Until that transition happens, I'll keep watching the data closely, respecting the structure and positioning around the highest probability setups I can find. I'll catch you all in the next one. If you're serious about Bitcoin analysis, my full custom indicator suite is now live. Built for investors looking to gain an edge through deep cycle signals and advanced on-chain insights. It's available now through the link in the description, where you'll also find my free newsletter. And if you found this valuable, hit the like button, subscribe to the channel, and turn on notifications so you never miss an update. And I'll see you all in the next one.